Welcome to the Investment Frontline here at Brooks Macdonald. I'm Pippa Lyons, the Head of Portfolio Management, and I'm joined today by our new CIO, Will Hobbs. And today we're going to be discussing the world of finance, economics and markets in what is a fascinating time. So Will, welcome.
It is indeed. Thank you, Pippa, and it's a great pleasure to be here. I'm very honoured to be both in the business and on the podcast. So, looking forward to the discussion.
Great. So today I believe we're going to be discussing about the superpowers of today, the opportunities and the risks, of course. So it'd be really helpful if you could start by discussing your views on the US economy.
I will try. I will try. Yeah, not easy. I mean, just as a sort of preface, I guess. I mean, when thinking about an economy as kind of large, diverse, complicated as the US, I always sort of think that we exaggerate, and this is partly due to the media narrative, but we exaggerate the role, the agency of the leadership. We sometimes sort of portray these economies as kind of puppets with the policymakers like central banks and, the White Office kind of holding all the strings. But it's obviously not like that. And most of the time, actually, the caricature is actually in the opposite direction, where the leaders and central banks and so on are in yoke to the pre-existing trends in the underlying economy and so on, rather than the other way around. And that's probably even more the case when you're starting to see the fruits of this next industrial revolution sort of really take hold, and it's even starting to show up in the statistics, so the latest productivity data, and this is usually the last place where it shows up. The statisticians always pick these things up way behind, and we got examples from the late 1990s to give on that. But actually, you're starting to see not so much generative AI, but the previous advances in machine learning really take hold and start to transform the economy. So you would think that the leaders have even less agency at times like this. But this is where I think we had a competition how long it would be before I mentioned President Trump. This US administration would certainly seem to be trying to do more than doing its utmost to upset that story. So you've obviously had, and I won't need to teach anyone on this podcast about this, but you've had this kind of bizarre tariff blunderbuss, and domestic and foreign policy directed as if everyone had been playing way too much Call of Duty or maybe Steven Seagal fantasies or whatever else. But anyway, so far the economy, I would say, just in answer to your question, has proved a lot more resilient to that disruptive force in the Oval Office I chair, to the incredible dynamism of the economy from Silicon Valley to the financial engineers on Wall Street, and they remain the envy of the world for the most part. And actually, if you speak to Chinese policymakers, that's still what they point to, is that incredible dynamism in the US. Some of the resilience that we've seen so far could be down to the fact that a lot of the policies we've seen, or some of the policies we've seen from the Oval Office, have had a performative aspect, let's say. So, for instance, the tariffs that were announced on Liberation Day, they were never really enacted as such. So, what was enacted was some way below what was sort of shouted about to start with. And there have been some restraints on the leadership that have kicked in. So the Supreme Court struck down President Trump's use of something called the IEPA. I can't even remember what it stands for now, but that was used as the kind of medium by which they would sort of express tariffs in the first place. We'll see whether they try and go to other sort of weapons of tariff destruction. But
is there a risk, though, that with Donald Trump being in charge of the US, the credibility has been destroyed? I don't know. I mean, we'll go on to discuss China, but having somebody of that nature in power.
It's certainly interesting, isn't it? And that's certainly a lot of the debate going around in markets at the moment. But I would still say that a lot of the debate on the US century really, and for our sort of purposes, it's about the role of the dollar in the economy and the investments and so on. A lot of that will actually really depend on what happens in the world of investment. So, we'll talk later about, what's going on with the tech bros, giant investment splurge, or possibly, a bonfire of money, however you want to see it. And that will be much more important, in my opinion, than what's going on in the Oval Office or the, Truth Social feed. We shall see. I mean, you can do a lot of damage. I guess my argument would be, to a degree, the question I would ask, let's say, is President Trump a lot less moral than previous, or all sorts of characteristics than previous US leaders, or just a lot more visible? We just didn't see behind the scenes and into the head of a lot of previous leaders in the way that we do President Trump. So he may not be as different as he sometimes seems. It's just the moment we're living in is quite different.
We had quite an insightful debate actually last week at our equity research forum, where we were discussing, our positioning on US equities. And clearly, with it being a highly efficient market, it lends itself well to passive investment. So that's where we're leaning at the moment. But clearly, there are some, exciting selective opportunities out there as well. So one to watch.
Yes, I'm interested. So, because unfortunately I was on the road for this meeting, but so were there any other things that came out of the meeting? I know that you guys were talking a little bit about sort of quality growth stocks and some of the other interesting areas at the moment.
Yeah, quality growth as a factor and what role it has to play in portfolios is a really fascinating area.
So just before you go any further there, just tell me when you're talking about quality growth companies, what exactly do we mean? So we're all on the same page.
Yeah, so we think of quality growth as companies who have clearly demonstrated market leadership. They consistently show or deliver high returns on invested capital, recurring revenues, and they do have that competitive advantage. But the questions we've been asking ourselves, is that advantage being eroded by AI, and at what rate? So I think it's quite interesting seeing Apple's latest announcement about their new CEO. So they've announced that the head of hardware engineering will take over from Tim Cook as CEO moving forwards. So I think that really clearly demonstrates that their commitment to hardware over software is actually going to go on into the future, and perhaps it's because they see software as an area that is at risk of being disrupted by AI.
Super interesting. I mean, for me, Tim Cook will go down as one of the greats, I have to say, in terms of, and more than anything, for his restraint. The temptation running a company, being CEO of a company like that must be, and if you've got to that level, you must have an ego of sorts, I guess. And so the temptation, as we're seeing on show in some other companies, is to participate in the races going on elsewhere and to kind of splurge like they have. But Apple has showed, and this is obviously, before I go any further, there are no recommendations for stocks on this podcast. Of course, we're talking as an illustration of, how you guys think about things and all of those kind of things. So none of this can be construed as a recommendation to buy or sell any stocks. But that is a really interesting aspect about Apple's past, is just how much they have been discerning in the battles that they've decided to fight and where they're going to play to their strengths. And, there's a lot of people who talk about, when you're looking at companies, the companies that are sometimes the most attractive investments are those that realize their age. So it's like if, I decided to turn up with a youthful haircut, let's say. I think a mullet seems to be in favor at the moment. It doesn't look right. And I think often in companies, you try and think about the same thing, that those that accept their age and act accordingly are often the most attractive investments. But yes.
Yeah, absolutely. Yeah, it's sort of having that sort of self-awareness, isn't it?
Self-awareness, yes, as my children constantly tell me. Well, also, you got me thinking a little bit on something else, just sort of back a step with regards to sort of geopolitics, because it's so interesting hearing you talk about, how the equity committee is just focused on those, those fundamental drivers of stocks. And a lot of research teams and investors around the world at the moment, you can get very easily swayed by what's going on in the papers, the geopolitical temperature and so on. And we get a lot of questions on that about, why would I want to sort of, commit capital now? Why can't I how should I focus on everything that's going on in the world and all the tragedy that you're seeing in various parts of the world? And in a way, back to that kind of industrial revolution example, I would refer people back to a prior period of incredible geopolitical stress, and we wrote about this in the quarterly actually, the 1950s and 60s. And this is a period obviously with memory of far worse, where you get, the Korean War, where General MacArthur turns around to President Truman and said he wanted to drop something like 30 atom bombs on China. President Truman thankfully said no. You've got France in Vietnam, America in Vietnam, terrorism all around Europe is beset by terrorism at that stage. Various near misses for nuclear catastrophe. There was that famous story, I think we were talking about it on the desk, where one of the guys, one of the Russian dudes who was in charge of the early warning system, came back from his lunch and the screen was flashing up red and everyone was telling him to press the button, but luckily he checked the system and it was a mistake. And through that period, long story short, I'm sorry, rambling on, actually you found strong returns for markets and strong economic growth. And the point is that the driving force during that period was new technology and the assimilation of new technology. And that was what was driving economies, not an array of bad policy making all over the place and domestic and international. You see that in the UK, and the market returns followed. So long-winded, I'm sorry, but it's an important point to get across at the moment because it's something that's really worrying, understandably, many investors.
Yeah, I mean, another thing that we did discuss at the Equity Forum was the fact that, companies are staying private for longer. So arguably a lot of that growth that they experienced earlier on in their life cycle isn't being shared with public markets.
Interesting.
So
yes.
Obviously we've got some big IPOs coming up.
Well, I was going to say, what does that mean for you guys? I think, what have we got? OpenAI, I think we've got SpaceX, haven't we?
Potentially Anthropic.
And potentially Anthropic as well.
Yeah.
Do you guys how much attention do you pay to the kind of potential valuations being putting on display as an influence to what you're thinking?
I mean, the scale is vast, isn't
yes,
it?
It is.
We are considering the dilution headwind that may have on markets.
Yes.
Clearly, we saw evidence of this in China. And it does make you question the valuations, doesn't it?
A little bit, I have to say. I mean, certainly some of the things that are getting talked about do feel quite top of the market. But yes, I mean, again, that's another worry at the moment, isn't it? This idea that we're in a bubble, yes, and that sort of, that is another deterrent. It's always hard to tell, isn't it? I think we'll know ex post in better detail. I don't know what your views are. Do you worry about that stuff, or is that too far out of the...
Yeah, it's interesting because we do try and be selective. Clearly, we look at valuations to ensure that we mitigate some of that potential extreme valuation risk. But yeah, I mean, bubbles can go on for a long time, can't they?
They can indeed, and often there's a really interesting study by a guy called, I think it's Walt Goetzman, Yale professor of finance, and he was sort of talking about the number of times over 100 odd years of market history across however many markets where what looks like a bubble at the time ex post is revealed to be a sort of phase change in technology and the underlying thing. So quite often markets are right in these positions, and it's very difficult to separate the sort of wheat from the chaff. That's not a bad expression. I can't even work out if that works or not, but anyway, we'll go with it. For me, I have to say, I mean, just looking, and this is something from a top-down level that's, certainly something I'd make, I guess, 3 points. I mean, one, looking at free cash flow yields is quite interesting, relative to 1980 to today. The free cash flow yield up until Q3 last year looked very similar for the US market. So that doesn't tell you, the free cash flow obviously is everything you're left with as an investor. So it doesn't tell you the potential return. It doesn't tell you much about what's going on in future investment terms. It just tells you what's been, I guess. But up until Q3, and then since then, you have seen quite a sharp decline in the free cash flow story of some of these titans. Maybe that's just a blip. Maybe the bros are just setting fire to stacks of cash. We shall see one way or the other. I mean, if it's a blip, it'll be the returns on this investment coming through. The second bit, I think, is, and again, it gets back to this investment story that you were talking about. They're making big plays on AI infrastructure. And there's a guy, Aswath Damodaran, who talks about the big market delusion, which is essentially, 5 overconfident guys sitting down at a poker table and all believing that they're going to win big. Someone's going to be, or a few people are going to be disappointed, and maybe that's the case this time around. And the third thing is really just about bubbles and, the history of bubbles. And if you look from Mississippi onwards, a couple of things I think are always present. One is this idea that there's a kind of future you can almost touch, whether it's a continent rewired by railroads or the internet or something, where it feels almost tangible. And then is the financing regime, where it suddenly becomes easy to buy that future today. And I'm not sure I'm not sure the degree to either of those things are quite present at the moment. I could be horribly wrong. But you mentioned China anyway, and I wanted to just talk on China. Here are your views on how you guys, yes.
Well, starting from the top, we're quite cognizant of, the structural headwinds facing the Chinese economy. It's well documented, the aging demographics, weak consumption, and, issues in the property sector. But there are some really fascinating things happening beneath the surface.
Yeah.
And not just in humanoid athletics. I don't know if you saw
Amazing,
that.
amazing. Yeah, the backflips. Yes. I wish I could do that, but yes, it's been a long time.
Yeah. So there are some really supportive dynamics actually. So the Chinese government has really pushed forward these anti-involution policies. So that's the aim of reducing the competitive forces so that you do try and preserve that profit margin and you don't end up in these destructive price wars that we saw historically. So that's really, really helpful for certain Chinese economies. We're also quite cognizant that they have ambitions to be a technological superpower, but it feels like they're framing this from a different angle to the US, whereas the US is looking at things more in terms of the digital large language models. It feels like China's really going down the robotics route, and that's having some really interesting factors driving their automation and efficiencies, really. So
Fascinating. Yeah, fascinating. I mean, it's kind of, yeah, I mean, again, from the top-down perspective, I'd almost go the same as I did the US and sort of be careful about exaggerating the agency of the leadership. Even though it is more of a command economy, they have more levers to pull than, in the US. It's, yeah, I mean, I still think the elephant in the room for China is the property crisis. These things go on for a long time. They may have gone through the peak, and the top tier cities may be starting to show signs of life again, but the reality is I think that sort of a lot of the provincial cities, which is the overwhelming majority of the population still, are still going to be experiencing some headwinds there. Yeah, I mean, the other thing I always think about China is that we always talk about the China shock when thinking from the Western perspective, all of our rust belts and the northeast of England, and all the sort of in the US and northern France and various other bits and places. But the reality also is that China has suffered a China shock. You've had 500 million people migrate from rural to, these multiplying cities in the space of a couple of decades. And, and you mentioned sort of, the aging population, but you've also got like 20% youth unemployment. You've got these huge, and now these kind of proliferating dark factories, where the lights never go on because there's no workers in them, so they've got their own troubles to kind of deal with in a way. But like you say, it's really interesting that they've got such an interesting loads of investment opportunities there for sort of active management and so on. But I would say, the next stage of development really is a complicated trick. If past is prologue, you might even require some individual freedoms to make it work. So it's kind of yes.
Yeah. I think from my perspective, valuations are still relatively fair in China, and expectations are low.
Yeah.
So that combination
it's interesting.
Could be a good starting point for an interesting investment story.
Yes, one hopes so. One hopes so.
So I often get asked why invest now? Clearly, there's a lot going on.
Yeah, you're not alone on that. Yes.
So I'd be really interested to hear your thoughts.
Yes. Well, Pippa, I mean, we've covered quite a lot of it already in a way, just in terms of sort of trying to frame the geopolitical moment right and trying to put everything into context and, not sort of calm, relax, not sort of believe that there are no problems whatsoever for the world to solve. There are plenty, but just that they are not insurmountable, and that what's most underestimated about our past is actually our capability at problem solving. That's what the last several hundred years in particular really shows in terms of human development. And there's no reason now to suspect that that's at an end. I do think that, I mean, I've been rattling on about this for several years, but, we are in an industrial revolution. That has become increasingly apparent, and that follows on from the information revolution that was really kicked off in the mid to late 1990s. And actually, as you've shrunk transportation and communication distances with mobile phones, quicker transport, or video conferencing tech, now social media. We've all been forced into each other's arms to a greater degree. So that kind of explains some of the populist moment as well. That is part of the jostle that humankind has to do with, because we've now got 7% of the people who have ever lived alive on the planet today. So that's quite a sort of, problem to overcome in many ways, but it's also a huge advantage, because if you think about, innovation being in the world of ideas, we are responsible for the ideas, of course, humans. So the more of us there are, the better our chances should be. And that, the translation of that into investments is important, because productivity growth, which comes from innovation, is what drives long-term economies and investment opportunities. So what you're doing by investing now, in a way, is you are essentially buying a call option on future human productivity. You are saying that on a 5-10 year view, I think we're going to make more stuff and get better at using that new stuff. So the fact that there are more of us now, replete with education, opportunity, and the rest, should be a significant advantage in that long-term story. So that really is why I think you try and stick with a diversified mix of capital markets assets, and just try and stick with it through all the kind of bad news flow and difficulty and all that kind of stuff, and acknowledge that, the incentives of the media companies and so on, providing you with those news, is not the same as, your incentives to stick with a long-term investment portfolio. It's just, there's a sort of, a difficulty, I guess. So yeah, can I finish off on one point as well? I haven't finished ranting yet, which is unbelievable. But the other rant I had, a long-term rant actually, alongside the productivity one, is actually on the UK economy. People seem to love trashing the UK economy and its prospects. I mean, it's the IMF does it as regularly as clockwork. That's when philosopher King Ray Dalio isn't having his go. But the reality on the ground has long been quite different, in my opinion, anyway. And people can, this may mark me out as entirely insane, but traveling around the country, as I do a lot, in part in my previous role as a CIO and economist and those kind of things, but also kind of more recently, the sense I get is actually on the ground of a much more vibrant story. And that is starting to be backed up by the statistics again, the latest GDP data, incoming unemployment data. They're all much better than feared. And, that then takes you onto this obsession with government debt. I mean, it's bizarre, to be honest, because the reality, and this is, you can all do the maths at home if you like it, but it is your expectations of debt to GDP. A, it's not that remarkable in history, 100% debt to GDP, like you don't have to go that far back. And B, it is minutely sensitive to tiny changes in your trend growth rate assumptions. So most of the doomers are saying, well, look, we're never going to grow beyond 1% ever again, and this is the same ad infinitum, therefore the debt goes up and up. But actually, if you say we return to our post-World War II, pre-Great Financial Crisis average of around 2.5%, your debt to GDP goes to almost zero in the space of 50 years. So completely ignore that story. It's not that there are no problems at all, but remember that the UK economy is blessed with a strong consumer with plenty of savings, still just about enjoying real wage growth. Yes, there is a hit coming down the pike of, this energy shock, but it is not yet looking like a one that could completely upset the apple cart. So let's not get too carried away. And remember that the UK has lots of competitive advantages that are including its institutions, universities, an incredibly array of sort of vibrant cities from Manchester, Glasgow, London, all the rest. So don't get too gloomy. Everything's going to be all right.
Yeah, brilliant. Will, thanks so much. It's great to hear your thoughts as ever. I look forward to discussing further with you as we move forward.
I'll try to be less ranty in future, but I can't guarantee it.
It's great to get your perspective. Thank you.